So I'm going to talk about some tax planning, particularly from an elder law perspective. And I'm going to be talking about trust and trust taxation. Yay, there's no more exciting topic than trust and trust taxation. But we're just going to talk about trust. So first, like, what is a trust? I always say to my clients, it's really just a written set of instructions. It's a set of rules that govern what happens to assets. To say that somebody has a trust isn't any more descriptive than to say that somebody has a car. Really, what type of trust is it? We're going to talk about different classifications of trust and particularly why that's really important for tax purposes. But what happens is a grantor, sometimes people call it a donor, transfers an assets really to another person, really kind of in some ways owned by that trustee. The trustee rules it, governs it, and manages it for the benefit of a beneficiary. The trustee could be the same person as the beneficiary, but the donor, trustee, and beneficiary can't all be the same person. That fails to be a trust because there's just too much. So when I think about trust, I always think about worrying about, a closet. So if we think about like what's in your closet, like what's in the trust, is the door open? Is the door closed? Do I have access to it? Who has access to it? And so as I talk today, I'm going to be kind of talking about that and using that kind of metaphor to talk about different types of trust. Of course, what we hear often about is revocable versus irrevocable trust. And if you get nothing from me today, then just this one thing, an irrevocable trust can be a grantor trust and often is a grantor trust. Nothing irritates me more than something I did yesterday, which was filling out a form from a financial company where somebody's selling annuity and they're asking me to choose, is it a revocable grantor trust or is it an irrevocable non-grantor trust? And the type of trust that we're using is an irrevocable grantor trust. And I am sure of that. It's the type of trust we use all the time. And we're going to talk about reasons why we do that. And most of them, to be honest with you, are income tax reasons. So we want to step up in basis. And we're going to talk about that and why we do that. So from the perspective of understand for me, revocable versus irrevocable is kind of a continuum. Some trusts that we do are really revocable. Some are really irrevocable. Most of what we do is somewhere in the middle. So when we talk about trusts we use for protecting from the cost of long-term care, or trusts that I would use, like a dynasty trust that I would use to protect a farm to go, or a hunting cabin to go down generations, it's kind of in the middle. There's some parts of it that are revocable and some parts of it that are not. And usually they're always a grantor trust. For those of you who don't know, we're going to talk about the rules of grantor trust, but understand they're IRS for IRS purposes. If it's a grantor trust, in some ways, the IRS has determined that the grantor has so much control over this asset that we're still going to put all the tax to the grantor. Now, there's ways around that, but generally that would be the default thought of it. The non-grantor means the grantor doesn't have any control. The person that gave it, the donor, the person that put the stuff in there, and we're going to tax it otherwise. And so we want to be thinking about that. Of course, the biggest consideration is who has the keys, who can get in. What access does the grantor or the donor or the maker of the trust have? So if I'm that grantor and I put my house into a trust, what ability do I have? Do I have the ability to sell that? Do I have the ability to sell it and buy something new? Do I have the ability to, once I sell it, take the liquid money out? Do I have the ability to say who gets it upon my death? So for instance, all the time I have people who have come to me, they set up an estate plan, they want to benefit their kids. They come back 10 years later and they decided that they like their grandchildren better than their kids. And so they want to switch it from their kids to their grandchildren. So, do they still have the power to do that? When I first started my career, much more of the trusts that we did were for federal estate tax planning. So we wanted to not pay federal estate tax. Those types of trusts are really irrevocable trusts. You can't, and we're going to talk about this today, but you have to really understand if I'm doing an ILIT, an irrevocable life insurance trust, or I'm doing a trust that's completely a completed gift and I want it out of somebody's estate, they can't have any control. They can't have keys. They can't open the door. There's so much of the federal tax clause that will bring that back into their estate if they partially give it away or retain any strings of ownership. And so now, interestingly, we're going to talk about some of those taxes. And, you know, when I first started my career, the exclusion for taxes was 600,000. In 2024, it's going to be 13 million, but it's going to sunset. And so we'll think about that. So when we think about types of trust, as I've talked, I have talked about different types of trust, but for irrevocable trust, they can be inter vivos. That means it's a living trust. It's something I'm making today while I'm living, and I often fund it today while I'm living. It also can be funded at my death. My will can pour over to it, same trust. There's also trusts under will. You will not see my office do very many trusts under will at all. I don't like them. And the reality of it is a trust under will. So I have a long will, and there's a trust that's created upon somebody's death in their will. The reason that that's problematic is that the law is going to judge that trust by the laws when somebody dies. So particularly like a special needs trust, a trust that we would use for children who have disabilities, there's changing laws in them, federal and state. So I would do an inter vivos trust for that during life. And the day that I set it up, that's the law that I have to comply with. If I take that same trust under will and I set that up for that child who has a disability, I'm going to have to judge that trust by the laws when somebody dies. Well, I don't know what they are. Also, I think trust under wills can be problematic with IRAs. So we're taking that trust and we're throwing an IRA into it, and we have to, particularly, we're going to talk about the Secure Act later, we have to comply with all of that. Honestly, too, my job as an attorney, I believe, is to make it simpler and easier when people die and to reduce costs, like probate costs. If it's a trust under will, by definition, it's coming into your probate estate. It's going to cost more money. It's also subject to more creditors. So you won't see my office do very many trusts under wills. I understand that lots of law offices still do, but I'm pretty strong about that. I don't think there's any reason to do a trust under will. And I think they can have extra problems and extra costs to the beneficiaries. And usually when people are coming to me, they're setting up a trust to get rid of some of those costs, to make it simpler and easier. Life insurance trusts, also a lot of charitable trusts, like a charitable lead trust, a charitable remainder trust. We do quite a bit of those. But just so we know, any of these trusts could be a grantor trust for income tax purposes, but a completed gift trust for federal estate tax purposes. So they're a more complicated choice of trust, but if I did an ILIT, for instance, an irrevocable life insurance trust, I may want it to be a grantor trust. So the grantor, the person that set it up, the older person that has the life insurance that's paying the premiums, gets the tax consequences flown to them. But we want to make sure it's not part of their federal estate. So we can do that. And we're going to talk more in depth about that. First of all, we just have to understand a little bit about the difference between federal estate tax and gift tax. For federal estate and gift tax, the burden's on the donor, the person that gives it away. If I give gifts to children that are taxable, I have to pay the tax. It's really a tax on my right to transfer assets during my life. And we're going to talk about how Pennsylvania law is different, but that's what the federal law is. And so right now, these are the 2023 things. I have to tell you guys, I updated this PowerPoint way back in October when we first started this. And then I didn't think about adding the 2024, but I looked them up. So in 2024, the federal exclusion is going to be $13,610,000. So its inflation index goes up a little bit every year. But in 2025, if the government does nothing, if they take no action, that exclusion amount is going to sunset back to what it would have been previously, but inflation index. Last time I looked this up, that was estimated to be 6.2 to 6.8 million. But I did just relook it up this morning, and now the estimates are about 7 million. And I think that's probably because of inflation. I think that estimate's probably going to go up a little bit. So at our office, we are planning with people as if it's going to sunset. Our bet is on the fact that the government's not going to be able to take any action. You decide how you feel about that, but that's my thought at this point in time, that it's going to be allowed to sunset. The annual exclusion, so for a lot of my career, the annual exclusion was $10,000. When I first started, everybody come in and say, what about the $10,000 I'm allowed to give away? And it was like, doesn't even apply to you. But it was flat for many years. It's now inflation indexed, but every 3 years it goes up. It is going to go up in 2024. The exclusion for federal estate tax, gifting, and a federal estate tax is going to be $18,000. So it only goes up. It's inflation index, but it only goes up when it like flips another 1,000. So like in 2025, it probably won't go up. 2026 or 2027, depending on inflation, it'll probably go up to 19. But for 2024, it's $18,000 as that annual exclusion amount. So clearly, with a lot of clients, we don't worry about this. But I certainly have clients that we do. And I have a lot of clients that we have to think about the 7 million if it sunsets back. And it's important to understand that life insurance is included in this. Values of businesses are included in this. And what I find, I have a case going on right now. I find that a lot of people, when somebody dies, doesn't even value a business. We have to value these businesses. They must be reported on the federal estate and inheritance tax. And so those of you who are attorneys on here, I urge you to really think about values of businesses. They have values, and we need to be reporting them. I get all kinds of cases where somebody didn't report them, and the accountant refers it to me because they know these people should have gotten a step up in basis, right? So if you're an accountant on here, you want me to include things in the federal estate because that the basis is going to step up to that amount, and then you're going to be able to depreciate a property, or if the person sells it, you're going to be able to use that basis against capital gains tax. So, I mean, I could talk about that for the 50 minutes I have. I won't, don't worry about it. But like just, that's a really important thing. And it is something that I see like a lot of people just aren't paying attention to. And it really matters down the road. And again, usually it's big, the referral to me comes from the accountant because they know more work could have been done that would actually really benefit. So even small things, when we think about this, when we think about Pennsylvania inheritance tax, understand it's very different than the federal estate tax. Pennsylvania inheritance tax, the burden's on the person that receives it, the transferee. So if somebody, the default in Pennsylvania law is if you receive money, you have to pay the tax. Now, most law firms are going to do one inheritance tax return and pay all that tax out of the residuary of the estate. But if the will doesn't say anything, it's actually on the person that receives it. And so it's really the opposite of the federal. It's really your right to receive assets that you end up paying it. And in Pennsylvania, the inheritance tax is 0% to a surviving spouse or a parent from a child age 21 or younger. And we have cases like that going on all the time. Please know, when I started my career, there was inheritance tax between spouses. Boy, they were not fun conversations. Nobody would want to pay it was a 3% tax at the time. If your spouse died, you had to pay tax. That was difficult at best. But interestingly, Pennsylvania law doesn't say that there isn't a tax. They say that the rate is 0%. It'd be very easy for them to change that. So when people say there's no tax between spouses, that's not true. There is a tax. The rate is 0%, which means that those things should be reported on inheritance tax returns. And so our office was just involved with Landon, and just involved with a case where they were trying to tax trusts when one spouse passed away, and we did not think they should be taxable, and really went to tax over a series of years with our Department of Revenue. and we're able to come out and it's not taxable between spouses. So, or taxed to the children at the first spouse's death. To children, it's 4.5%. That includes stepchildren, grandchildren, any of those direct lineal ascendants. 12% on transfers to siblings, and 15% to anybody else, like the mailman. Or the thing in this category that's always hard for me as an attorney is nieces and nephews. Nieces and nephews come in the 15%. So if I'm working with somebody who wants to give money to their niece and nephews and charity, I don't want to do a will that says, $100,000 goes to this charity and the rest residue remainder to my nieces and nephews. I want to really think about the assets. So highly taxable things like the IRA and stuff, I want to give that to the charities. And if I have any life insurance, I want to give that to the nieces and nephews because that's not taxable at all. There's no inheritance tax on life insurance. So, that's how Pennsylvania deals with this. Now, please know, here's where attorneys and accountants really kind of have to work together. So let's say that we have a house and somebody gives the house to a child for $1, and they're doing that to avoid inheritance taxes. I have people come in my office all the time saying they don't want to pay inheritance tax. And I always say to them, typically you should pay inheritance taxes and get a step up in basis. So if your children are going to sell it, they're going to pay less capital gains tax. Because if I'm paying 4.5% versus 15-20%, again, we don't know. So we don't know when the house was bought. So we have to figure out that. But a lot of people that I work with, they bought their house in 1960 for $19,000, right? And they haven't kept track of any of the expenses. So their basis is nothing. They sell it during life, they get exclusion from the sale of the house. If they give it to their kids and their kids sell it during their life, they're not going to get that exclusion. If they pass away and they don't pay inheritance tax and they turn around and sell it, they're going to pay a capital gains tax. So the real issue we have to think about is which is the worst tax. I say to my clients, you're going to pay one of them. Let's decide which one's the better one. Now, different if the person bought their house in 2022 and they already have a high basis. That's a different conversation, but not something that I get into a lot. That's why in our situation, when we do trusts, particularly that we put people's houses in, but they're not going to avoid inheritance tax. They're going to avoid probate, but they're not going to avoid inheritance tax. Typically, we're going to pay the inheritance tax, but we're going to get the step up in basis at death, and we're going to turn around when it's sold and not pay as much capital gains tax. So important. So reasons for grantor trusts, I apologize, include, federal state tax planning that I've talked to you about, provide for the grantor spouse, creditor protection, any of those types of things. So an example of an easy grantor's trust says, at death, all net income of the trust or estate shall be paid to the grantor's spouse in convenient installments, at least quarterly, until the death of the grantor. That's an example of wording we see all the time in a Q-tip trust, a qualified terminal interest trust, or an RLT, or revocable living trust. So this is a simple grantor's trust. So I put my rental properties into a trust, and I say I'm going to retain my rights for all income, or my spouse is going to, upon my death, it goes, and my spouse's death, it goes someplace else. That by definition is a grantor trust. It could be irrevocable. I'm likely to make it irrevocable because beyond the scope of this, but the reason I'm going to likely is because of a realty transfer tax in Pennsylvania. So if I make it so that the only people that can receive it through that trust are lineal descendants, people that would be exempt anyways from realty transfer tax, I don't have to pay a realty transfer tax to get it in. That's why you'll see my office come out with trusts a lot more than LLCs, because to get real estate in an LLC, I'm going to pay that realty transfer tax. It's 2%. So important. But this situation, that's an example of a grantor trust. This, I'm sure it's difficult for you to see it on your screen, but this is a visual that we use with our clients for a revocable living trust. And you'll see these one trust document, but often something that we do, we use this type of trust that is a grantor trust, a revocable grantor trust. This has a Clayton tax election, which means I get to decide at death whether or not I'm using what people used to call AB trusts, a surviving trust, a Q-tip trust, or a family trust. And then you'll see the boxes at the bottom, child number 1 and child number 2, that's trust for each of the children. So I like, upon death, if there's money, to leave that money to the children in trust, even if they're their own trustees, because that gives them creditor protection, and some protection from divorcing spouses. So again, just an example of a use of a grantor trust. You know, and again, for federal estate tax planning, providing for the grantor's spouse, creditor protection, income tax planning, you know, moving forward. Now, I talk quickly because I know I don't have a huge amount of time, but please, if you have any questions, don't hesitate to put them into the chat. Happy to do that. For non-grantor trust, the trustee pays the beneficiaries the net income or principal or both of the trust as the trustee or other beneficiary acting as the trustee deems advisable, or there's a HEM standard, health, education, maintenance, and support. And later on, we'll see where that is in the tax code. But when you see somebody coming out with health, education, maintenance, and support, that is a tax standard given to us by the IRS that says I can have a HEM standard. I can give this to another person, my spouse, and she can have access it for health, education, maintenance, and support. And that is an ascertainable standard. And for those reasons, it's a non-grantor trust, and it's not going to be included back in that person's estate. Now, please know where I see this goes wrong. I can't use a HEM standard. A HEM standard is a tax standard. I can't use that when I'm trying to do nursing home planning. HEM stands for health, education, maintenance, and support. You can't make a trust that's protected from the cost of long-term care that says it'll pay for your health care. Health, education, maintenance, and support. Yet I see a couple of those every year. But if you see that, you use your common sense. It doesn't work. So I don't care what the person says it's trying to accomplish. We shouldn't be using HEM standards in there. Also, HEMS is hard. We do use those. We use it a little bit more often for children. So when I pass away, my kids are going to end up with their own trust. They're going to be their own trustees of their trust, subject to a HEM standard that allows them to have some pretty easy access, health, education, maintenance, and support. It's not included in their federal estate again. It doesn't always work as well when you're dealing with blended families. So if I say a spouse has a HEM standard, well, we could argue about what those words mean. What is health, education, maintenance, and support? So I don't like using them in that situation. It does legally work, but that's just my own thought about it. So what are my reasons for a non-grantor trust? Well, creditor protection, federal gift and estate tax planning, income tax planning, Pennsylvania inheritance tax planning. So not unusual that I have a trust that I've done for nursing home planning. And I think the person should remain in control, husband and wife, one dies, the other one's, you know, in their 90s, has a good amount of money. I don't want to not pay attention to Pennsylvania inheritance tax. So if what's in that trust at that time is not something that I need to get a step up in basis on, that's CDs or annuities that are income in respect of a decedent, then I might make them a non-grantor trust at that point in time, both when I feel comfortable that the person's giving up control, and also when I'm trying to, at that point in time, avoid federal estate taxes. And again, in this situation, you'll see on this chart some of the HEM standards. So you'll see that we do use that quite a bit. And so again, that's important when we're thinking about grantor versus non-grantor, because HEMS allows us not to be a grantor in that situation. All right, Kyle, we need to go to the polls. So we need everybody to answer this. A grantor trust allows assets to grow tax-free, much like an IRA. True or false? So remember, somebody's paying the tax. It doesn't matter if it's grantor or non-grantor, it's just who is. So it is true. It is false. A grantor trust does not allow things to grow tax-free. The reality of either it's a grantor, the grantor is paying it. So in a grantor trust, that means that we're putting it back on the grantor's tax return. Some people are going to put it actually on their own 1040. Some people are going to do a 1041. I prefer not to get an EIN, use the social security number and put it back on that 1040. The problem in Pennsylvania with that is that Pennsylvania says you're still supposed to do a PA 41. Every accountant I talk to has different ideas about that. And we typically will follow what their accountant wants them to do in that situation. So if we think about this from a grantor trust perspective, since the grantor retains certain powers, the grantor pays the tax. Doesn't matter if it's on the 1040 or the 1041. So the closet's, still within their house. Like if you think about it from that, I have a trust, but that closet's still in my house. And so when we think about that, something that we can, visualize. A non-grantor trust, the closet's in another house. In that situation, for a non-grantor trust, the grantor's not paying it. The trust itself is going to pay it. Or if we're worried about high income tax, we're going to send it out to the beneficiaries, to the children. So let's slow down here a little bit and really look at I know, it gets more and more exciting as I talk. We're now going to look at the IRS tax code. I wish everybody was as excited about it as I am right now. I have to say, for those of you who have your cameras on, you're not looking as excited as I am. So there's a question here. Are we filing gift tax returns for irrevocable trust at the time of creation? Yes, George, we are. If it's a completed gift. So a lot of the trusts that I do, we would not, because it would not be a completed gift. So nursing home trust that I do, if you see a trust that says protector trust, that's probably not a completed gift. And so only if it's a completed gift. But yes, I do think that you should be doing gift tax returns. So to our office, we can do them. We don't like doing them. If somebody has an accountant that can do them, we think you're the better people to be doing that. Although we find a lot of people maybe don't want to. So we will do them if they're not wanting to. So the grantor trust rules, the one everybody knows is this one. So section 676 of the trust code says, or I'm sorry, the IRS code says the power to revoke. This is a revocable living trust. Everybody knows this one. If I have a revocable living trust, I have the power to revoke it. It's a grantor trust. And down below, you'll see in each of these slides, I put for you the code that brings it back into the federal estate. This, again, is not difficult, but 2038 is going to be the one that says, I gifted something to a trust, but because it's revocable, it comes back in my estate. It's not something anybody struggles with. But there's more. So we're going to go over the rest of them. A reversionary interest. So this code is 673. And that means the grantor has a right of reversion. So an example of that was, I give this land to the school district to build a school on it, as long as they use it as a school. If they ever stop using it as a school, I have a right of reversion. I have the right to get it back, that it reverts back to me. That is going to make it a grantor trust. And it's also going to be included in their federal estate tax under section 2037, because they have the right to pull it back based on their rules. So we don't do a lot of these, but I have in my career, people have given land to kids as long as they use it for certain purposes. If they stop using it for those purposes, farming, hunting, those types of things, it comes back. That's a right of reversion, the right to pull it back to you. Now, sometimes people pull it back to other people, but I do have clients that pull it right back to themselves. That's going to make it a grantor trust and includable in their federal estate. 674 is the power of disposition. So who it goes to and how it goes. So in 674, the power holder is related to or subordinate to. So this we have to think about a lot. What if I make a trust, I make my child who's subordinate to me have the power to change who can get it, that it's still in my estate. It's still a grantor trust. It's still in my estate. The law would look at that and say you haven't given up control because that person is subordinate to you. Now, interestingly, the way you get around that quite easily is you use an ascertainable standard, the HEMS that I just talked about, or you put two kids together. It's like in my situation, I couldn't just pick one kid because they theoretically are subordinate to me. I don't know, not in my household, that doesn't seem to work. But if I put two of them together, by law, two children, two beneficiaries that are siblings, by law are considered to have a conflict with each other. They're an adverse party to each other. And so that works in that situation. So I can do that from that perspective. The power to add beneficiaries. And again, that's in 674, B, C, and D. If I have the ability to add a beneficiary, that's going to bring it in my estate. And we often add that. And again, often people add grandchildren. It's a good power. It's a power people want. I mean, you can talk to my mom. My mom will tell you that she really likes her grandchildren better than Buddy and I, and she has set up her estate so they get it all. And what happens there is on 2036 of the federal code, that's what brings it back into the federal estate. 2036, if you've never read that, I think it's worth reading. It is the most expansive power. It's the power that says, if I give anything away and have any strings at all, it's coming back into my estate. And remember, some of this is good. So if we're trying to avoid federal estate tax, it's not good. It's the thing that, to be honest with you, a lot of people who set up family limited partnerships for the gas and oil rights, I'm telling you right now, a lot of them aren't going to work because of 2036. If they retain the power to change things, 2036 is going to say you never gifted it. You didn't gift it away. It all comes back in. So if I give my house away, technically, and I still retain the power to live there, like a life estate, 100% goes back into my estate. So I didn't really give anything away. I still live there. And so 2036 is pretty all encompassing. This is just about the power to add beneficiaries. We can also understand that it's an incomplete gift. So in that situation, I have the power to change a beneficiary. It's coming back into my estate. And so it's an incomplete gift. I'm not doing a gift tax return, and it's going to be part of my federal estate tax. It's hard, though, just so you know, this is one of those that's really hard, because sometimes I technically should do a gift tax return, and it's still going to come back into my estate. And it's going to be counted twice. So you really have to watch some of these when you're thinking about it, particularly if you're worried about federal estate tax. 677 is another one. This is just the power to use income to pay life insurance premiums. This is going to bring it back into somebody's estate. It's going to make it a grantor trust and make it taxable within their estate. So what are the powers, if we think about it? So what I told you is there's a whole bunch of ways to make something a grantor trust. And we want that for income tax purposes, because we want the grantor to still pay the tax at their tax rates a lot of times. And a whole bunch of times that I do that, I'm bringing it back into the estate. Well, what if I want my cake and eat it too? What if I want it to be a grantor trust for tax purposes, but I don't want it, I want it as a grantor trust, so it's an irrevocable trust, but it's a grantor trust, and I don't want it included in the federal estate. These are the safe powers. These are the things that I can put into a trust, like an irrevocable life insurance trust. I would come out with these powers. I want during somebody's life, I want that person, the grantor, the older person, to pay the income tax. I don't want a complicated thing, but I don't want it to come back in their estate. These are basically the only powers you can use to do that. So if you get a trust, the first thing you want to do is say, is it a grantor trust, right? And there's a whole, 671 to 677 will tell me all those powers. We just went over them. But then I want to think about, well, which powers did they use? And that's going to tell me whether or not I'm getting inclusion in my federal estate. So the power to add charitable beneficiaries, that's one. Don't use that a lot with real estate because that's going to trigger a realty transfer tax. Powers to make loans to the grantor without adequate security, that's enough to bring it in. Power to substitute assets of equivalent value. I use this one a lot in federal estate planning. It's probably my favorite on this list, except for it doesn't work for nursing home planning. So it shouldn't go in a trust that is for if I'm worried about paying nursing home costs. Power to use income to pay premiums on insurance. These are it. So these create what we call an intentionally defective grantor trust. I don't know why it's called an intentionally defective. It is intentionally a grantor trust that also we would be doing a gift tax return for, and it's not included in my federal estate. No client wants to pay a lot of money for something that's intentionally defective, so I usually don't call this to my clients. But if you're reading about things or you're out there, that's what people call it, is an intentionally defective grantor trust. We use these all the time. You have your cake and eat it too. So if I have an older person and I want the tax to go to them during their life, but I don't want it in their estate, an intentionally defective grantor trust is the way that I should go. So we think about this. Important questions. Is the trust a grantor or non-grantor trust? And here's where I'm going to even get more specific, because most people don't even pay enough attention to this, but also you can make grantor as to income or grantor as to principal. So one trust can be different. I could be, the status applies only to one or the other. And where I end up using this sometimes is for veterans trust that we use for veterans, where I want it to be, it has to be a non-grantor trust for veterans purposes, but I want it to be a grantor trust for the house. That's for principal. So non-grantor for income, but grantor for principal. In case I sell that house, I want to get the 121 exclusion. So as long as I have a grantor trust, I can still get that exclusion during life. Please understand, it doesn't matter if it's an irrevocable trust. None of what I've talked about today, like if it's a revocable trust, by definition, it's a grantor trust. If it's an irrevocable trust, it just means you have to look closer at it. And a lot of the trusts are grantor trusts that people are using. All right, next poll, grantor versus non-grantor. This type of trust offers the power to revoke and to add beneficiaries. The answer is a grantor trust. So the power to revoke and add beneficiaries could be a revocable living trust, and that's always a grantor trust. All righty. So I know for some of you, you have more experience with this than others. And please know that this would be really what would be considered a more advanced topic. I know that I am going through it in a way that is relatively quick. But please know you can get access. I'm happy for you to have access to my PowerPoints and the materials which lay this out. So next we're going to get excited. We're going to use the type of trust that we use for houses all the time. So it's a grantor, it's an irrevocable trust. It's a grantor trust and an incomplete gift. And if we look in the Treasury regulations, it says a gift is incomplete if to the extent that a reserve power gives the donor the power to name new beneficiaries or change the interest of the beneficiaries as between themselves, unless the power is a fiduciary power limited or fixed by an ascertainable standard. So in our trust that we do to protect assets from the cost of long-term care, we use this concept. And we do that because we want to put it into a trust. We want it to be a grantor trust so that really nothing happens with the tax, right? We don't have to do a 1041. It's up to us whether or not we do a PA 41. We're not doing a gift tax return here because we have not completed the gift. And basically within that trust there's a paragraph that says, I give this to my children, but I reserve the right to name other beneficiaries. I reserve the right to name new people, to add grandchildren. Now, I'm going to limit that a little bit because I don't want charitable bequests in there. Why? Because that's going to put a realty transfer tax in Pennsylvania. So we do this quite often. And this is just giving you the actual wording out of our trust that does that. And this is something I've just provided for you if it's something you would like to read at bedtime, look further into, you're really excited about this topic. But that's the regulations. A grantor trust for principal in this situation, it basically just says in here, we have the power to change the beneficiaries for the remainder, which is in 2.2, trust principal, but doesn't retain the power to change for 2.1, distributions of income. And again, that would be a type of trust that we would use in veterans benefits planning because the Veterans Administration requires that type of trust. Now, when the grantor only owns the income portion and then only taxed on ordinary income items, typically the trust is taxed on the capital gains. It's always hard when we're doing a 1041 because we think about income, and I'm having all this conversation about who pays the tax, and often the capital gains stay within the trust anyways. And so we want to think about that. We also, so I've talked about we can be a grantor trust for income or principal. We also can be a grantor trust for a specific asset. So here's some wording that talks about, like it says excluding life insurance. So during the lifetime, we reserve the independent right to reacquire any of the property except for the life insurance. So it's a grantor as to everything, non-grantor as to life insurance. So there are times that we get that specific in what we're doing and what we're drafting. Can the trust elect to have the capital gains taxed to the beneficiary? You'd have to distribute it. You'd have to distribute it to them. Usually when we're doing that, to be honest with you, I would have the trust to pay it because and so some of this, just so you know, also becomes a family situation. So the reason we're worried about ordinary income is because there's increasing rates for that ordinary income and we're getting to high tax brackets. And a lot of times when we send it out to children or the donor, they're not paying as high of a rate. Capital gains isn't quite the same, because it only goes up to 20%. And what happens sometimes as a practical matter is if I have the beneficiaries pay the tax, they're ticked off at me because they have to pay the tax. So if they're supposed to get $200,000 and I pay $20,000 in tax and give them $180,000, they're okay with it. If I give them $200,000 and say you have to pay $20,000 in tax, they get all up in arms. Yes, you can do this. I often don't because it's easier to pay the tax for the beneficiaries so that I don't have to deal with 5 different people paying their taxes differently and their advisors. Final one, a grantor trust and a completed gift. Again, I already kind of talked about this. This is the power of substitution. So I'm kind of going back over what we already talked about. But if you look at this PowerPoint, you're able to figure out this is the wording that I actually do. I already talked about the fact that the power of substitution allows me to be a grantor trust and not be included for federal estate tax purposes, which is really exciting. The grantor is still getting the tax, but when they die, it's not going to be included in their estate. And I do that by the power of substitution. And I'm just providing here the wording that I would actually use in those trusts. So this is an administrative provision, a non-grantor trust, and a completed gift. Typically, I'm going to do that by them having the power to change administration. Administrative provisions, I want them to have some power to do some things. That's hard. This is a hard one because what really is administrative? Basically, you have to know an administrative amendment that we can do cannot change a beneficial interest. Cannot. I alluded to this. Trust creation and taxes. The reason attorneys, financial advisors, CPAs, we all have to work together is because what we choose to do on one end affects another end. particularly basis questions. So in a non-grantor trust, so this is a trust that's not a grantor. It might be an irrevocable trust. I worry about this all the time. So the donor's basis transfers to the donee. So if I bought something for $10,000, and I put in a trust, and the person passes away, and it's a non-grantor, and I decided to sell it, the fair market value at death is $100,000. So I have $90,000 of gain. I'm going to pay that tax. But if it's a grantor trust, I'm going to get a step up in basis, right? And so I'm going to pay zero capital gain. So it's really important that we think about these things. And so I know it's a complex area of the law, but it's an important thing. And the way that I try to deal with it is I try to put things in categories. You hear me talk about, this is what we do for Medicaid trust, because a typical client wants the same thing. We want to step up in basis. We have to do our due diligence to make sure. For federal estate tax purposes, an irrevocable, intentionally defective grantor trust, I'm going to be doing this. And so we have to really make sure. But thank you all. I appreciate everybody being on. I know it's not as exciting being virtual as in person, but we can cover a larger area. So we're always here to help serve you. I'm always open to answering any questions or collaborating with you for our clients.